So I'm very happy to be here to present market segmentation, competition, health insurance. This is joint work with Kate Ho at Princeton and Nate Mark at the Department of Justice. Let me start off with some motivation. What do we mean by segmentation? Well, in the US, people obtain insurance from different sources. About 8% of people are uninsured. But of the remainder who are insured, it's roughly 1/3 are getting insurance through a government program like Medicare for the elderly, Medicaid for low income, and about 2/3 are getting insurance through the private sector. If we look at the private sector, this is a breakdown within Oregon. Oregon's going to be our source of data for the rest of the paper. Roughly 900,000 people are getting insurance through self-insured employers. Think MIT, NYU. There, your premiums depend on who else is in your firm. But in the fully insured market, it depends not only on who's in your firm, but also all the other groups that are purchasing. And they're broken out separately by each of these defined kind of segments. So there's the large group segment, about 600,000 people. We're going to be focusing today on the small group and the individual market segment. In the small group, your premiums depend on who else works at your firm, but also all the other small groups that could be purchasing the plan in that market. In the individual market, you'd be purchasing on your own. And when you do so, the premiums depend on kind of who else is purchasing on their own. So each of these is segmented. And so the question for us broadly is to ask, well, what are the consequences of this insurance segmentation? And the kind of scorecard we'll use is to think about, well, how do insurance participation, how would that change if we change these market boundaries? What happens to consumer surplus? And also what maybe happens to changes in public expenditures. Okay, and we're going to be focusing on merging the individual and small group markets. And part of the reason for this is because under the Affordable Care Act, these markets are regulated very similarly. I'll go into a little bit more detail later, but the plans here are defined by the same financial terms. So you'll hear me use metal tiers like gold, platinum, silver, bronze. And those metal tiers are a specific actuarial value, meaning you pay 20% out of pocket or you pay 30% out of pocket. And this is the same for plans that are in the small group market and in the individual market. In addition, the market is defined by what's called community rating and guaranteed issue, which means insurers can't reject you based on your past illnesses. They also can't charge you different premiums based on your past illnesses. Okay? It's about 30 million people nationally in these two markets. And what we're going to be able to do with the model is talk about a new policy called Individual Coverage Health Reimbursement Arrangements, or ICHRAS. And why this is relevant is because under this arrangement, the employer gets out of the business of offering you insurance, and instead they set up a tax-advantaged account. You take that money and you can go buy individual insurance. So it's essentially like merging employer coverage and individual coverage, because everyone would be buying on their own, just using tax-advantaged money from your employer. Okay, so we're going to be able to simulate an environment where these small groups start giving these accounts, and instead consumers are merged with the individual market consumers instead of getting insurance from your employer. Okay, let me just give you a brief background on the economic environment to make our kind of model make a little more sense. In the small group market, if you were working for a small employer, you would be getting your insurance typically through your employer who uses a broker. So there's broker intermediation in this market in Oregon and in most states. Your employer chooses a plan on your behalf, usually one plan, maybe two plans. There's a tax wedge here because you pay your premiums pre-tax. And typically the employer subsidizes you. In this market, around 65% of the premiums are paid by the employer. If instead you didn't get insurance through an employer, say you're like an architect or you're a startup kind of person, you don't work for an employer that offers insurance, then you would typically go to a marketplace website, you'd purchase a plan there, you pay post-tax for those plans, and only if you're kind of a low-income person, you would be eligible for subsidies from the federal government. Okay, so they're set up differently, and there's this intermediation that happens in the employer market. So what are we going to think about in terms of the economics of what happens when we pool these markets? Well, on one hand, there's this adverse selection question, which is if the risks are different between the markets, so say small employers tend to have healthier people than those who select to buy individual coverage, then you could improve selection in the individual market by shifting these consumers over. Of course, you'd worsen the selection for the small group consumers because they're healthier and now they're pooled with sicker folks. From the government's perspective, you could get lower premium subsidies because the premiums would fall. There's another aspect here that I tried to highlight already, which is that there's agency in the small group market. So if I move these consumers over, I could also eliminate that broker intermediation. I could eliminate the fact that the employer chooses on your behalf. Both of those factors could lead to markups, and potentially I could have this trade-off where maybe there's sicker folks in that market, but maybe my premiums are going to be lower because I avoid those markups. So we're going to be looking at this using data and our model. The data comes from Oregon Health Authority's all-payer, all-claims data set from 2014 to 2016. We're going to observe people's plan choices. We're going to observe premiums. We're going to observe very detailed claims level data on individuals' healthcare spending. Okay. In addition, I'll come back to this in a little bit. We observe what we call forced switchers in the small group market. So those are individuals who are going to migrate to individual coverage or uninsurance. With the upheaval of the ACA, there were some small employers who ended up not offering insurance anymore. Those employees then had to go search for a plan from other sources, from the individual market. We're going to use this data to recover a distribution of underlying health severity, of risk preferences, moral hazard, and then we're going to be able to use a model to predict equilibrium premiums under counterfactual policies. So when we merge these markets, we're going to allow the insurers in the market to change their premiums in response to these consumers and in response to the other insurers' premiums. Let me tell you a little more about the data, and we'll get to the model. So we're looking at these two markets in Oregon, individual and small group coverage. There's around 350,000 people in the individual market over these years that we're studying, around 218,000 unique people in the small group market. Tend to be single or at least obtaining insurance on their own, separate from a spouse, about 70–75%. If they do have kids, it's around 2, slightly larger in the employer market. Average age is around 40 to 45. The small group market is similar, but a little bit more of them live in the urban areas in Portland and Eugene and Salem, as opposed to the rural parts. When we look at the plan choices, there's something that strikes us immediately that's going to be important for our modeling. I mentioned these plan metal tiers. They're the generosity of the plan. Bronze plans, you pay about 40% out of pocket. Silver, you tend to pay 30%. Gold, more generous, only 20% out of pocket. If I look at the shares across the two markets, what you can see is that in the individual insurance market, people choosing on their own, roughly 30% are choosing the least comprehensive bronze plans, and around 15% are choosing the most comprehensive gold. If I look at the small group market, you can see the flip. It's something like 35% are choosing the gold plans, and only around 15% are choosing the bronze plans. I'll show you in a second, the small group people are actually healthier. So it's something we're going to have to be careful of later to distinguish whether that gold preference in the small group market reflects the employer or reflects the individual employees.
So small group are healthier.
Small group are healthier, and they're choosing the more comprehensive plans. Yeah. So you'll see later, I'm going to have risk aversion. I'm going to have moral hazard. I'm going to need these components because there's something going on with their plan choices that's different from their underlying. Okay, so let's look at the underlying health, and then let's look at some markups. So here's a picture conditional on the plan generosity. So within a plan's generosity, what you can see here, I've got the individual market in orange and the small group in blue. And you can see over on the side, I've got the fraction that are spending 0 per month. A lot of people don't go to the doctor at all per month. And it's like over 35% in the small group market, closer to 20%. So there's a greater share of these small group consumers, both in the silver plans and in the gold plans, who spend nothing. And then if I look at the distribution, so you can see kind of the small group in blue is closer to the 0 point. So there's more consumers who are spending less in the small group than in the individual market, conditional on the plan. Okay. But when I look at the premiums are actually higher in the small group market. So you can see here across all the years, the base premium is higher in the small group market. And so if I translate that into a medical markup, just total premiums over medical costs, you can see that there's higher markups going on in the small group market. So there may be, in this instance, a situation where the small group consumers could be merged with sicker people in a joint market, but actually could benefit from avoiding some of the markups they're seeing in their current small group arrangement, also because of intermediation and some other reasons. Okay. If you're in the weeds of this healthcare area, there are certain programs that operated in 2014 to 2016 that gave insurers additional money if they enrolled sick folks. And so to make things adjusted, I could bring in those additional funds that went to individual market insurers. But you can see even with the adjustments, it's still true that the small group markups are higher than the individual market. So I have to account for these kind of payments, and I do once we estimate the model. So let me tell you a little bit more about the model, and then we'll kind of think about some counterfactuals we can run in a second. So I'm going to first talk about demand and then supply, and there's two stages to the demand model. First, we'll have a plan choice, and that's going to feature risk aversion and adverse selection. And then we'll have the medical care utilization with moral hazard. On the supply side, I'm going to start with a kind of perfectly competitive environment because that's going to allow me to solve for the equilibrium here using a paper by Acevedo and Gottlieb. But I'll also show you what it looks like if we have markups in the merged market as well. So let me start with stage 2, and then I'll go back to stage 1. So stage 2 is the medical care utilization. Here's a look at the utility for an individual. And you can see it starts with this kind of quadratic in medical expenditure. You've got income, out-of-pocket costs for the consumer, premiums, and then there's also this additional function that can have other factors that might affect utility, like maybe you prefer Blue Cross Blue Shield, all else equal. Or maybe you have a preference for a particular type of plan because of your income background. So that's another little bit of the weeds, but there's an emphasis on silver plans if you happen to be low. If I take the first order condition here, I get this kind of optimal medical spending, and it's got two components here. The lambda is the underlying non-discretionary healthcare needs of the person. But there's this additional component here which reflects moral hazard. So omega is my moral hazard parameter, and I specify this in a multiplicative way. So we've got, my underlying non-discretionary healthcare needs, but then I'm going to do a little bit additional spending if I have moral hazard. So if I react to the fact that the plan is more generous, that's what X is telling me the fraction of the costs that the insurer covers. So if the plan is more generous, I'm going to do more moral hazard, right? The moral hazard is multiplicative with lambda, which is I have more opportunity to kind of do additional spending in healthcare if I'm sick. And so in this way, I'm going to allow there to be this kind of moral hazard that reflects the individual's underlying healthcare needs. Okay. When we think about the plan choice stage, it's going to look like this. We've got this exponential in here with the caret preferences, because I want to allow for risk aversion. I want to come back to this question that we saw in the raw data, which is that individuals who are observably healthier tend to choose more comprehensive plans in this market. So I'm going to need to allow there to be potential for risk aversion to reflect that I'm healthy, but I still want to have a more comprehensive plan. Okay. In this, there's an informational assumption here, which is that the household is going to anticipate that their health needs follow this distribution F of lambda, that's their non-discretionary healthcare needs. And they're going to kind of choose their plan with the optimal second stage medical spending behavior. Okay. We've got these caret preferences. And so we can take this to the supply side too. We're going to estimate this in a joint likelihood I'll describe in a little bit. But if I know what the household's optimal medical spending is, then as the insurer, I could compute what my expected claims costs are going to be. Well, I just need to integrate over the distribution of that underlying healthcare need. And here we've got these X's because this is the fraction of that medical cost that the insurer is going to cover themselves. Okay. If I were in a perfectly competitive world, I would set my premiums equal to average total cost with these medical costs and with my administrative costs. And we'll show you that there could also be markups in this case. Right, I want to translate this into an empirical model right now. So what do I have to do for that? Well, first I need to make a distributional assumption on this kind of underlying healthcare need. We choose to use an exponential, partly because if you remember those plots I showed before, the spending looks kind of exponential, of course, but for that zero spending. So we have an exponential distribution here, and I've got to adjust for the probability of somebody having a zero spending month. But then I get this nice convenient form for that utility when I assume this follows an exponential. And it looks like this with these additional terms. Let me see if I can explain for you what each of these is going to tell us. So there's a disutility from premiums. There's a utility from covered non-discretionary spending. So X is the fraction of the costs that the insurer is going to cover. So you can see here, alpha is the parameter of the exponential. If you're familiar with the distribution, the mean of it is 1 over alpha. So if alpha is larger, it means that the person is actually healthier because their expected spending is lower. And so here, what you can see is that the utility I get from having a more generous plan is going to be lower the healthier that I am. But if I'm risk averse, then this parameter of risk aversion is psi here. So if that's larger, then this gets smaller, this thing gets bigger. So if I'm risk averse, I'm actually going to value having more generous plans as well, even if I'm relatively healthy with the alpha. Okay. There's, because of the form that I have for moral hazard, there's this additional term here that reflects additional utility that I get from the spending due to my preference for moral hazard. And then we have these additional components, non-financial characteristics of the plan that I might choose for plan J. Those could be the insurer's identity. It could be some other characteristics.
Right?
Yeah.
This is really the indirect utility, right? It's
Yes.
It's the indirect utility derived from the utility they showed us before.
Yes, it's for these households. And then I'm gonna, I took an expectation here. It's just that because I have this convenient functional form, it kind of works out nicely. Okay. Great. So on the, again, on the insurer side, well, we have these expected medical claims costs. We can integrate over this distribution. And because of the form for that distribution, I get this kind of nice form for costs. Here, again, what you can see is that if alpha is large, if the parameter of that distribution of spending is large, we end up with kind of small expected costs. We're going to be assuming that the insurers here are risk neutral. Some other notes on implementation. I talked about having this distribution, this exponential distribution, but we have really rich data on claims. So we know everybody's spending over the course of the year, how many times they go to the doctor, hospital, prescription drugs. We see all of that. And so we use software behind the scenes that insurers use from Johns Hopkins that enables us to predict each individual's expected spending based on their past claims history. And so when we implement this, we're going to have like individual specific alpha, individual specific distributions with a parameter depending on all of this rich data that we have, including the demographics of the household and all of their past claims. We account for price endogeneity here using some nice features of this market that allows there to be statutory formulas that affect variation in premiums. And as I mentioned, we saw in the data that some people spend 0. We have an exponential that can't hit 0, so we have to adjust the distribution here to account for the probability that consumers will spend 0. Then we do this joint likelihood with both the household's plan choice and the health spending. I'll come back to this when we look at the results, but it's important that we observe the health spending and use that in our likelihood to recover the moral hazard spending. Okay. So let me show you this as we look at the results too. One other point before I show you the results, I mentioned that we want to recover preferences of people in the small group market and consumers in the individual market. And when we look at the plan choices in the small group market, of course, there's kind of the employer behind the scenes choosing those plans. And so what we use instead, at least to recover the preferences, is to look at a population of forced switchers who were forced out of their small group plan and then went to the individual market to choose. And so what we're going to learn from those consumers' choices is something about how they weigh all of these elements of moral hazard, of risk aversion, of the plan's generosity when the employer is kind of not behind the scenes. And I wanted to show you in this picture, there's only 16,000 of these switchers relative to the 383,000 in the whole small group, but they look kind of, in general, pretty similar, a little bit more likely to have kids, a little bit, tiny bit sicker, and so we'll account for those characteristics. All right. So let me show you the results. First, on the demand side, I've got two sets of columns here representing the individual market sample and then this forced switcher sample of those consumers who are pushed out of the small group plan. And the way to interpret the moral hazard here in this first row is going from 0% to 100% coverage. What's the additional spending I'm going to do as a result of kind of tendency for moral hazard? Here it's 11%, or 22%, depending on which of these specifications we focus on. In the main individual market sample, and here it's 22% in the switcher. So it's about kind of double. So you'll see the moral hazard in this case is higher, and that reflects the data, which is that for the same underlying predicted healthcare expenditure needs, the people in the small group market actually spend more. And so these switchers are spending more. We have to rationalize that in the model with a higher moral hazard parameter. When I look at risk aversion, here's the risk aversion parameter. We tend to write it in this loss aversion setting, which is like I can either have a $100 for sure, or a gamble between $0 or X dollars, and I want to see what the person would be willing to take. Closer to 0 is more risk averse. Closer to 100 would mean they're risk neutral. And you can see that in this market, they're kind of what we're recovering is risk aversion parameters that are closer to risk neutral than extremely risk averse. But the switchers are more risk averse than the individual market consumers. And so from that, again, what we see in the data is that conditional on the plan, on the underlying healthcare needs, the plan choice tends to be more generous, more gold plans amongst the switcher population. So we're finding them to be more risk averse. Okay. So we're going to take these parameters. I can translate them into expected spending. We have more kind of fit measures in the paper, but one way to think about this comparison is I can compute the expected non-discretionary healthcare needs of these folks. This is both the sum of what the insurer spends on your behalf and what you spend out of pocket. And the average, this is in hundreds of dollars. The average is around $500, $550 in the individual market. The spending in the small group market is around 520 or 420. So again, they're healthier, they're spending less. Conditional on having kids, though, people in the employer market tend to spend a little bit more. Okay, so we're allowing for this heterogeneity across demographics and also across these two markets. Right, so then on the supply side, we take the empirical model, we take our kind of predicted costs, and then we can write down what we would kind of equate revenue to this underlying healthcare costs as well as administrative costs. Okay, and here there's this additional term, gamma 1 here, which is important because, as I was mentioning earlier, there's some additional payments that the insurer gets from the government if they happen to enroll very sick people. That's mostly present in the early years, but that's where our data come from. And in addition, there could have been differences when I set premiums. I have to set them ahead of time between what I expect my costs are going to be and what my realized costs are going to be. And so we want to allow some flexibility here. That term could also be, if it's greater than 1, it could reflect markups. It could reflect the fact that when I set my observed premiums in the data, it's actually greater than the costs that I incur or expected to incur for my enrollees. So we'll see empirically whether that term is greater than 1 or less than 1, reflecting net payments or reflecting markups. Okay. There's an endogeneity concern here too, which is that my administrative cost unobservable could be correlated with shares, or could be correlated with the cost of my enrollees. And so we use kind of demand shifters as instruments in this part of the expression. Okay. We estimate this, we end up with 0.73 here in our preferred specification, which again means that instead of markups, which we would see greater than 1, what we're seeing is that there's kind of net payments to the insurer in this case. Or they're losing money, kind of one of those things. But here we observe that they're actually getting payments. Okay, so let me kind of take stock of what we have so far. We've got demand parameters both for the individual market consumers and demand parameters for the small group consumers. And we've got moral hazard, we've got risk aversion, we've got kind of a distribution of their underlying healthcare needs depending on each individual's observed underlying demographics and past medical visits and such. We have these parameters on the supply side to help us understand what the equilibrium pricing is going to be for these firms. And then we have a fixed point algorithm that's going to allow us to take all of the consumers choosing each plan, lets the plans kind of set premiums according to our premium setting equation. And then if sicker people enroll, they're going to raise their premiums. If healthier people enroll, it's going to lower premiums. And there's an algorithm that's going to allow us to get back to a situation where all the firms are, either just breaking even or having a fixed markup according to what I'll allow them to do in this case. Okay, so we've got those tools. And so now what I can do is I can change the boundaries of the market. I can move the individuals from the individual insurance market and the small group market together, and I can see what happens to sorting across plans, equilibrium premiums, cost to the government. Okay, I'm going to do this in a few steps. There's more in the paper, but I'm going to illustrate for you here two different counterfactuals. The first one, what I want to do is what I call kind of extending ICRA. Basically, taking away the employer insurance that individuals in the small group used to get, and instead giving them money, the same amount of money that the employer used to subsidize them, but letting them choose plans in the individual market. And so when I do that, I can kind of quantify what happens to both the individual market consumers and the small group market consumers. I have them in kind of two separate columns. When I look at the effects on the individual market, you can see that there is like this externality or external effect of merging the small group people in that benefits the individual market consumers. So their welfare in terms of consumer surplus goes up $28 per month when they've got these healthier consumers merged in with them. And I'll show you in a second, it's because the premiums fell. Right? The government expenditure also falls. Government expenditure is the subsidy that the government pays as a function of the premiums. They're price-linked subsidies in this market, and so those are going to fall when the premiums go down. We see also an extensive margin change where about 4% of people who used to be uninsured now, when faced with lower prices in this merged market, choose to kind of enter the market. And so we get a decrease in uninsurance as a function of this merger. Okay. On the small group side, well, first step here, what we see is that consumer surplus goes up a lot. And I'll tell you, part of that is because we're allowing them to choose to be uninsured. And many of the healthiest consumers in the small group market would rather be uninsured than insured through their employer. Okay, I'm going to do another counterfactual in a second where I actually I kind of mandate them to have coverage. We'll see what that looks like. The government expenditure falls. What is government expenditure in that market? It's tax subsidies. Essentially, because money is coming out of the paycheck to go toward the premiums, the government is losing that money. We call that kind of a tax expenditure. That's what I'm kind of saying here. If the premiums fall, that tax expenditure is going to fall too. Okay. So let me show you in this counterfactual what happened to premiums. I'm showing you them separately by bronze, silver, gold here. And the biggest change you can see is that the gold plans in the individual market used to be incredibly adversely selected. So the premiums are close to $100 per month. They go down to something like $350 per month when merged, because there's happens to be more risk averse, kind of slightly higher moral hazard folks in the small group market who are happy to choose the generous gold plans. So we get a better pooling even in the more generous plans here with the small group consumers. Okay? And part of what comes out, and I can explain in more detail as well, part of what comes out here is that even if the two markets had the same health states, so even if the small group market and the individual market had the same health, average health quality, when they come over to the market, if their preferences, because of risk aversion and moral hazard, are toward more generous plans, you still could see the premiums fall because you're getting kind of more healthy people pool into the more generous plans, even if on average they're the same health. Okay, in the small group market, their premiums also fall. You can see these are slightly different here just because they're in slightly different parts of the state, and these premiums reflect an average across the rating areas in which they participate. But even though they're pooled with sicker people, because their markups were higher before, they're getting actually a benefit in lower premiums now. That's what's explaining the consumer surplus gains that they see. So part of this effect, though, was driven by the fact that for some of these consumers, they chose to be uninsured, right? And if I can bring let's say, an employer mandate, which isn't out of the question, it's what we have now. The employer is offering insurance here through these plans, but also guarantees that those consumers buy a plan. We're going to bring healthier consumers in. What does that do? Well, relative to just having this kind of pooled market, if I also mandate insurance, well, then I get an even larger consumer surplus gain in the individual market, because now even healthier people are signing up. Government expenditure falls again, as I'll show you, premiums are going to fall again. And an insurance rate drops further. So now we've moved from 57% uninsured to down to around 51%. This uninsured might sound higher, but the individual market and the uninsured population are kind of roughly the same size. So what I'm talking about is uninsured as a share of like the individual market, not as a share of all of the market. In Oregon, it's something on the order of 10% of people are uninsured. In the small group, their consumer surplus falls relative to the case where they could choose the outside good because some of them actually preferred that. But relative to the baseline, it still is an improvement. And the government expenditure is a little bit higher now because more consumers are getting the insurance, and so we're having that tax subsidy. If I look at the premiums again, you can see that the biggest fall, the biggest benefit was just having these consumers in there. But if I bring in the consumers who would have otherwise substituted out in the small group market, you can see that the plan tiers are cheaper across all metals, but in particular for the more generous. So we're able to offer these generous plans at a rate that more consumers are willing to pay for. And again, the small group consumers are facing lower premiums in this market when you bring in the health issues. Now, this was done here in a case where we assumed no markups ex post. But of course, what could happen is you merge these markets and the insurers now exploit change their conduct and actually start charging markups over a perfectly competitive outcome. So we can kind of, in our simulation, we can imagine a world with markups here as well. And I'm allowing markups at the baseline of 0 all the way up to 25%, which is the maximum allowed in this insurance market. So insurers actually have a constraint on how much they can make as markups. If they make any more than that, they have to pay it back to consumers in checks. And so we're allowing the markups to go anywhere up to that 25%. And kind of the key takeaway from this figure, if you want to look at this line here that's dark, that's the small group market. This line toward the bottom is the individual market, imagining no markup ahead of time, but markup after the merger. What's important from this figure is that it's above 0 kind of all along the line. So no matter what markup we can imagine, it's still beneficial to consumers in this market to be merged. And so there's always a consumer surplus gain here. Of course, other things could change outside of this Oregon setting, right? We could have different moral hazard parameters in a different market. We could have a different mix of costs between the small group and the individual market. And we go through in the paper kind of an analysis with our model of imagining these parameters being different. When would our conclusions change about the benefits of the pooling? But I think kind of one key takeaway that I was describing before is, let's see if I can accomplish this here, is that if I were to translate this into heat maps, where say I change the underlying healthcare spending of the different consumers, here these lines are the observed one, but what if I kind of took away and made the individual market healthier? What if I had made the small group market healthier? This red dot here represents the point at which the two markets would have the same level of underlying healthcare needs. And what I want to emphasize here is that the surplus is still positive. I mentioned this before, but one way to kind of read this idea is that because the small group consumers have this preference for more generous plans, even when they're healthier, if I merge them together and everyone has the same costs, we would still have healthcare gains because more consumers would be choosing the generous plans.
Mike, do you think that isn't that in general true that you want to combine markets for competitive reasons and also for pooling risks? So is there any configuration of parameters or anything in the data that could give you the opposite answer?
So, I mean, a couple ways it could be the opposite. One would be, I pool in consumers that are just so much sicker that from the perspective of the individual market, that would lead to, higher premiums. So, I can change the sickness in that way, but it would actually have to be more than, both of them having the same sickness, because they're choosing more generous plans, so that's helpful. If we change the risk aversion parameters, and so even just staying within what are reasonable risk aversion parameters still tends to be positive in this case. But the markups are actually the main area where I think you could reverse this. So if you were in a market that had much lower markups and you merged with a market that, for whatever competitive reasons, went all the way up to the 25%, it could be that the small group consumers would be forced.
Yeah, but in that case, it would be marginally, it would be better because you benefit the other market that had either sicker patients or higher markups. So it's always better overall. So.
Yes. So creating these arbitrary boundaries between them is going to set you up for this, right? So it could happen at different points. And there's probably some consumer welfare story that I might have to weight different inequality on other dimensions and think about whether some consumers would benefit more from low premiums.
And then it's nice quantification.
Yeah. So we're actually it's not in the current draft of the paper, but we've been working on kind of thinking about that. That kind of who wins, who loses question. But for the parameters that we're seeing, there's a lot of winners in this case. Okay, so I'm actually close to done. Let me kind of sum up what we're finding here. What we see is that thinking about this market design and the boundaries between these markets is really important. And in this context, we can actually improve consumer welfare in both segments, because what we're finding is that pooling the healthier small group enrollees reduces adverse selection. Normally, that would be bad for the small group enrollees if their underlying healthcare costs are lower. You might think they should pool separately from each other. But actually, in this case, they're getting rid of the markups that we were seeing as a function of intermediation and such. And that small group agency is kind of the newer part of this paper. What we're seeing, the administrative costs are like $10 per member per month higher because of broker fees. And so that leads to higher markup. They could also be higher due to that tax wedge, and there's slightly more limited competition in that market. And so when you merge these over, it's beneficial to those consumers, but it's particularly beneficial if you're a younger, kind of healthy person in an employer plan. So when you think about going to work, and the premiums that you see at work, if you work for like a consulting firm where 80% of the people are 2 years out of college and the rest are older folks, then the older folks there are really benefiting from being pooled in with a lot of healthy young folks. If you're in a small group where you're one of the two young single people and there's a bunch of families in that small group, then you'd rather be detached from premiums being set with everyone in that small group. And so here there's kind of not just the group as a whole benefits, but also the members of the group could change. And so we kind of do a bit of a who wins, who loses, particularly on when I'm kind of pooled in with these other folks within my group. It could benefit me from being detached and in the individual market I'm in. And what we see in Oregon, at least in 2016 in this analysis, we're seeing that even if the individual market markups were to rise all the way to the 25% max, pooling still benefits the average kind of small group and individual market household. Okay, thanks very much. Yep.